So here's the setup today. We have the TNX, which is the yield index for the 10-year T-note. Now, that's going to be the inverse of the 10-year T-note itself, or prices on the 10-year T-note, which means that bond prices are going up, yields are going down. At the same time that in the market we have record inflation numbers. So inflation numbers have not been this high since the first Gulf War in the U.S., and we have equity prices on the rise. Now it's not an incline like we've seen here over the last couple of weeks, but nonetheless, you can see today we have a nice little increase on the SPX here. Now, I know a lot of analysts, including Ryan Siepels here at PFX, has been pointing out the fact that that the SPX itself is beginning to form what could turn into a ascending wedge, which, according to the previous trend, provides a certain amount of probability that the market could break out to the downside. Certainly, if this bottom support level were broken, we could conclude that we're going to see at least the lows from July. Now, so we have this setup basically where the equities are up, inflation is up, both of which should be pushing bond prices down as capital flows into higher risk assets, and yet what we're not getting is what we would expect. So this inefficiency is really what trading is all about. It creates the opportunity in the first place. If everybody knew exactly what the market should do, and then in fact the market did do it, well, we wouldn't have any opportunities at all because everybody would be able to know exactly what the market was going to do. So the takeaway here is that we're at an inflection point, which means a couple of things. One, it's an opportunity. So I'm just going to apply a little fib analysis to the top of the trend. By the way, that was the last surprising inflation number in June in the U.S., so higher than expected inflation. There was also a higher than expected inflation number in July, and as you can see here, the market did pivot on both of those days, but not in a reliable direction. So I'm watching this though, because if we draw a Fibonacci retracement from the bottom to the top, we're sitting right on top of the 38.2% retracement level, so a potential support. If we back up here just a little bit more, you can see that we're actually sitting at a longer term inflection point, if you will, or support level. Market bounced here in November, December, bounced here as resistance after the break in December and February, treated it as support in June and then again in July, and we're approaching that same level right now. So very interested to see what happens. There's a couple of ways we could take advantage of this. Number one, if you didn't know already, there are actually options on this index, the TNX, which is 10 times the yield rate. So in fact, yields are actually at 3.892, but it's priced at 38.92. So there's options available on that, which is one interesting way to take advantage of it. Selling a put here, assuming that the market should bounce up and start heading back up again, is very speculative, but could be an interesting opportunity. The other message that we're getting here is that perhaps if we wait to make a decision like that, but until either the market breaks the support level that it's at right now, or in fact does bounce off, we should probably start controlling some of our risk, because there are currency pairs that are definitely influenced by what's going on the TNX. So for example, the decline on the TNX lately has been, not just today, but over the last few weeks, has been it's been counter to the trend in equities, which makes for some volatility in currency pairs like the dollar yen. That counter trend movement since the 23rd of July could be a big reason why, excluding the breakout, of course, on the 6th, when the market was really getting shocked, we've had the yen in such a channel. So really, if you discount the breakout on the 6th, we get a very choppy, very volatile dollar yen. It's been not handling that disagreement in capital flows between rising equity prices at the same time that yields are going down. So rising bond prices and rising equity prices at the same time, not just today, but since the middle of July, does not indicate a really strong trend. So the takeaway here is that it's not only an interesting opportunity to potentially speculate on a bounce in yields, but from a more practical perspective, I think this is a significant signal for us to start controlling or taking a heavier hand with risk. Not necessarily to exit the dollar yen. I was looking for a bounce up off of this support level at 108.25 or so. We got that this week. It still looks pretty reasonable, but I think it's one of these positions where we get in with either conservative stop levels, give the market enough room to breathe, but don't give it too much room, or potentially buying a protective put against a long dollar yen position. I might even take the same kind of stance on the dollar franc, although the correlation there is a little bit weaker.